To DCA or not to DCA? That is the question. DCA is a fantastic strategy for a bull market, which I still believe we're in this year right now. But there is a major difference between using DCA with spot or futures. The main thing you have to understand between both of those is that the spot market, you can buy as much as you want. The price can go to zero. You won't get liquidated. But on the futures market, you can get liquidated. And the reason for that is because you're borrowing and you're leveraging the money that you're offering as your margin. So say you're using 10x leverage for $100, then you can use $1,000 to trade. So you can make a lot more money, but you can also lose a lot more money. So just to clarify the difference between spot and futures, okay? So here's the question. On the spot market, I use DCA all the time, but on the futures market, I get really picky about the charts that I DCA on, and I have to intentionally go into every single trade before I decide to DCA. But I want to show you a live example with a trade I have open right now on CoinCatch. So I open this one just as we all do, expecting the chart to do what we want it to do, right? Or let's be honest, let's be real. I did buy Trump right here, actually after the breakout, but I was using a different chart and I made a good little profit on this trade. It did go up higher and I decided to close it out fully for 10% on 10x leverage, which is 100% return, which is great. Now I've opened up a new position last night and I was hoping to just make a quick little 3-4% and then leave the rest open to see what happens. But unfortunately, the price decided to go against me and has fallen up to 13%. Now, this isn't to say that I am the best, amazing, most fantastic trader ever. I make losses. I make really bad decisions sometimes as a trader. So please understand in this video, I'm not here to flex the point that I make profits all the time. This is a perfect example of a losing trade. Right now, I'm down $1,322. So why did I open up this trade to begin with? Well, it's because it's volatile. It's been good for trading. I like charts that are volatile and that are whipping up and down. So this seemed like a good candidate since it was doing a lot of that. But now that the price has gone against me, is this a chart that I'll be using DCA on? Now, there is something you have to understand about this, and the text is really small. But down here, you can see in my open orders right here, it shows liquidation price and it says $32.162. We'll just say that. We're actually going to go to the chart over here on TradingView. So 32,162, something like this right here. We're going to make this a red X and say liquidated. Now, the goal in futures trading is not to get liquidated. The goal is to make money and to use a stop loss. Now, of course, this is a perfect example of me being irresponsible and not using a stop loss, even though I say it all the time. But I'm also banking on the fact that things are pretty bullish right now, and I'm expecting the chart to move. So there are a couple of decisions I have to make. Do I take a loss right now, and I am underwater by $1,300, which would set me back quite a bit, or do I DCA? Now, this is the golden scenario, not the golden scenario, the golden question, the $1 million or $1,300 question that a lot of you are asking. Because if you're using leverage and you're down a lot, you might be tempted to DCA. And the reality is that if you DCA on a losing position, what will happen is that the exchange will say, okay, sure, you can do that, but that increases or rather moves up your liquidation price. It actually puts the pressure on for your chart to actually perform. So if you're going to use DCA on a futures position, you better be certain that it's going to recover. Because if it doesn't, price goes down and then that's it. You get liquidated, and that's not what I want for this position at all. So before we do this, I actually have a really cool tool that I want to show you over here on TradingView. This is the DCA calculator by Queensland Bone. I've shown you this before. I'm going to go ahead and hide all this stuff and I'll talk about the trade in a minute. So this orange line represents the order entry price, $41.974. And I was looking to take profit. Actually, it was at 4% profit, but it doesn't matter. But here in the settings, something that's really great about this little free indicator that you can find, and I'll leave a link down below in the description, is that you can enable a manual safety trade order. So my size, it doesn't really matter how much the size is right here, or the take profit target. I mean, I could set it to 4% because that's really where it was. So the main thing is put in your entry price, put in how much you use for the trade. And if you just want to make this easy, just put 1. Now, the manual safety trade right here, this is where I was going to place a safety trade. And of course, the price is moving up. But what happens when we use DCA is we actually average down our entry. So this orange line right here that's thick shows our average entry price. And this green line is now our new averaged down take profit price. And right here, this line is showing us our DCA order. So the thing you have to know about this is that, yes, it looks appealing. Yes, it looks great. But remember, when we do this, our liquidation price that's down here at the bottom, all of a sudden gets moved up when we use, especially if we use 2 times the size. So what happens with our DCA if we don't use 2 times the base order size? So instead of using it as 2, let's set it to 1. Well, unfortunately, it does reduce and rather average down our entry price, but unfortunately, it doesn't do it enough to really make a difference. And it will probably only move up our liquidation price a little bit more. But of course, the more size we add, the more effective the DCA strategy is. And we really want to double down. But the problem with that is by doubling down and putting in more size, it's going to shoot this up a lot, which could be not so great. We don't want to be liquidated again. So the main thing we have to understand when using DCA with futures is that we need to have a lot of confidence that if we're going to use DCA, for one, go into the trade using a very small amount of size. Very, very, very small, like less than 1% of your account. And if the price goes against you, then you can buy on the dip. What if the price keeps dipping? This brings into a great question. You need to know your strategy. You need to have predetermined levels at which you want to buy, to average down your price, to sell in the dips. So if I were to look at this chart, and I'm going to bring back the Fibonacci retracements just to show you how I am doing this actually. The things that I'm looking at in this chart to help me determine if I'm actually going to do this is to draw a Fibonacci retracement from the top to the drop, and I can see, is the price struggling or above certain Fibonacci levels? Now it's struggling to break back above the 38.328, but last Tuesday, it did, and it actually surpassed it. So I'm banking on the fact that we might see something like that happen again. Another thing I might do is draw a trend line, which I have right here. So it's a trend line that we can see, and I actually believe we should draw another one, which is what I call a trend line fan. So the price is technically above resistance right now. And my main concern is that if the price of Trump goes up another 6% to $40, it might hit resistance and be rejected. We're going to get rid of that for now. And if we bring this back with our current strategy and DCAing at that specific target, that means that our take profit target might literally be at resistance. That's a huge risk. So I want to give you another tip when it comes to using DCA with futures. Reduce your take profit target. I know you want to make a ton of money, but when I bring down my take profit target from 4% to 1%, if I'm just trying to get out of a losing position, making 1% on a whippy chart like this, much easier. And the interesting thing is that when I use more size on a trade like this that already has, $1,335 in it, if I average in doubling down on this and I only make 1%, now my position size is going to be way bigger. I'm going to be putting in quite a bit, to be honest. I have to go over here and see. So the position is, here's our margin. So position is worth $12,000. So I'm putting in essentially $36,000 into this trade. If I only make 1% on that, then I'm making $360-ish, which is good. But again, the whole idea of this is to get out of the trade in profit. Now, the other obvious scenario is just cutting the trade at a loss. And with futures trading, sometimes that is the best thing to do. But if you are going to use DCA with futures, you need to go into the trade with the mindset, I'm going to use a DCA strategy, and I'm also going to accept and stomach the loss if I get liquidated. The goal in futures is not to get liquidated. The goal in futures is to protect your portfolio so that it grows steadily and steadily. And the risk with futures is that, yes, you can use leverage to make a whole lot of money, but you could also lose a lot of money too if you're not careful. Risk management is key. So for this specific trade, I'm waiting on a couple of more signals before I decide to dip my toes into this trade in DCA. I'll let you know what the outcome is. But finding whippy charts like this are extremely dangerous. It's extremely high risk. just in case you didn't know that already, with a coin called Trump, the official meme coin of Donald J. Trump. So the main point I want to get across, yes, you can use DCA with futures, but if you are, you need to go into that trade with that mindset already, like, okay, I'm going to go into this trade with DCA, therefore I'm going to use a whole lot less. I'm not going to go crazy in its position. I'm going to start small and I'm going to add at predetermined levels, not when I'm feeling like it's time to buy more, not when I'm feeling panicked, not when I'm feeling anxious looking at the position. You really need to have a lot of self-control when you start using DCA on futures. Now, I would love for you all to leave a comment down below to let me know what you think. If you've been in similar situations, how did it go for you? If you've used DCA on futures before, did you exit the trade in profit? How did it change the way that you trade futures? Etc., etc., etc. Let me know. And I would love for you also, if you don't already have an account on CoinCatch, I actually have a link down below. If you want to sign up and use it, note that you can't use this exchange with AllTrading yet. If you really like the exchange, you can ask the AllTrading devs to add it, but that's up to them. But the reason I'm showing CoinCatch, by the way, is because I did an exchange review on the Coin Bureau Trading channel. So if you want to watch that, you can. The exchange essentially is a non-KYC exchange. So I just want to make clear why I'm not showing AllTrade, but I'm showing this exchange, mainly because it's an open position. It's easier to show here. Okay, so until the next time, you know what to do. Stay awesome and stay in the green. Peace.